London, September 2007. Inside a quiet conference room overlooking Canary Wharf, a handful of hedge fund managers sit unusually still. Outside, markets are calm. The S&P 500 is near record highs. Volatility is low. Television analysts speak confidently about resilience. But inside that room, positions are being reduced. Exposure to mortgage-backed securities is trimmed. Leverage is scaled back. Liquidity is increased. There are no dramatic announcements. No headlines, no panic, just quiet exits. Months later, the global financial system begins to fracture. The myth of every market cycle is that crashes arrive as surprises. In reality, capital often moves before the headlines do. Not loudly, not emotionally, but deliberately. Smart money is not a conspiracy. It is simply capital that prioritizes preservation over participation. It studies liquidity, credit, conditions, and structural imbalances, and it leaves footprints. The question is not whether markets will decline. Cycles are inevitable. The question is whether subtle signals suggest that sophisticated capital is already repositioning. Across modern financial history, 5 signals tend to appear when institutional money quietly prepares for turbulence. Credit. Markets begin to tighten. Before equities, fall insiders, sell into strength. Liquidity dries up beneath the surface. Defensive assets outperform without headlines. Narrative optimism peaks while positioning turns cautious. Each signal alone is not proof. Together, they form a pattern. Signal 1. Credit markets tighten first. Equity investors focus on price charts. Smart money watches credit spreads. Before the 2008 crisis, high-yield bond spreads began widening months before the stock market collapsed. In early 2007, subprime lenders were already failing. The equity market largely ignored it. Credit markets are more sensitive because they price risk directly. When lenders demand higher yields to compensate for rising default risk, it suggests stress beneath the surface. In 2000, before the dot-com crash accelerated, corporate bond spreads quietly expanded. In 2022, before equities fully repriced inflation risk, bond markets had already reacted aggressively. When borrowing costs rise while stocks remain elevated, sophisticated capital notices the divergence. Debt is the bloodstream of a leveraged economy. When it thickens, the body slows. Signal 2. Insiders sell into strength. Corporate executives understand their balance sheets better than analysts do. While insiders sell for many reasons, clusters of selling during market highs can reveal caution. In late 1999, insider selling surged even as retail participation exploded. In 2021, executive stock sales reached elevated levels amid speculative enthusiasm in technology and meme assets. This does not mean every insider sale predicts collapse. But when insiders reduce exposure while public narratives grow optimistic, it suggests asymmetry in expectations. Smart money rarely announces fear, it simply reallocates. Signal 3. Liquidity dries up beneath the surface. Late-stage markets often appear stable. Index levels remain strong. Volatility seems subdued, but market breadth narrows. Fewer stocks drive gains. Small-cap companies underperform. Trading volumes thin out in riskier segments. Private equity exits slow. Venture capital funding tightens quietly. Before the 2000 crash, a handful of mega-cap tech stocks carried the index, while speculative names deteriorated. Before 2008, housing-related equities began weakening well before the broader S&P 500 rolled over. Liquidity is like oxygen. When it recedes, stress accumulates in hidden corners first. By the time it becomes visible in headline indices, repositioning has already occurred. Signal 4. defensive assets begin outperforming without attention. When institutional portfolios anticipate uncertainty, they rotate. Utilities, consumer staples, and healthcare stocks begin outperforming growth sectors. Gold stabilizes or rises despite calm conditions. Treasury demand increases even when equities appear strong. This rotation is subtle. It rarely dominates financial news during bull markets. In early 2007, defensive sectors quietly gained relative strength. In late 2019, long-duration treasuries rallied significantly before the pandemic shock triggered equity collapse. Smart money does not wait for confirmation. It anticipates fragility. The shift is rarely emotional, it is statistical. Signal 5. Narrative optimism peaks, while positioning turns cautious. Perhaps the most powerful signal is divergence between sentiment and positioning. Retail surveys may show extreme bullishness. Media narratives emphasize innovation, resilience, or new paradigms. Valuations stretch beyond historical norms, but institutional flows tell a quieter story. Cash allocations increase. Hedge funds reduce net exposure. Options markets price downside protection more aggressively. Corporate buybacks slow. In 1929, newspapers celebrated prosperity weeks before collapse. In 2000, the new economy narrative justified infinite multiples. In 2007, structured finance was described as dispersed and manageable risk. Every cycle has its rationalization. Smart money does not argue with narratives. It steps aside from them. Modern markets add complexity. Today, exchange-traded funds concentrate flows into passive vehicles. Algorithmic trading amplifies short-term momentum. Central banks influence liquidity directly. These dynamics can delay corrections. They can also intensify them. When liquidity is abundant, risk expands easily. When liquidity contracts, it contracts everywhere at once. Currently, global debt levels remain elevated. Interest rates, though off their peaks, remain sensitive. Corporate refinancing costs are rising relative to the ultra-low rate era. Commercial. Real estate faces structural strain. Private markets show signs of slower deal activity. None of these alone guarantees a crash. But historically, market peaks are processes, not events. The exit is gradual before it is visible. For individual investors, the goal is not imitation of hedge funds. It is awareness of structure. Consider a simple framework. First, monitor credit spreads and lending standards. Credit stress often precedes equity stress. Second, observe insider activity trends rather than isolated transactions. Third, evaluate market breadth and participation beneath headline indices. Fourth, track relative performance of defensive versus speculative sectors. Fifth, compare public sentiment to institutional positioning data. When multiple signals align, risk-reward changes even if prices remain elevated. The deeper lesson is philosophical. Markets are social systems built on confidence. Confidence expands leverage. Leverage amplifies returns, but leverage also magnifies fragility. Smart money understands that survival compounds faster than speculation. It does not aim to predict the exact day of collapse. It seeks asymmetry, limited downside, sustainable upside. In every major downturn, the loudest participants were rarely the first to leave. In 1929, 2000, 2008, and in countless smaller corrections, the pattern repeated. Capital moved quietly. Then, headlines caught up. The presence of these 5 signals does not demand panic. It demands discipline, because the most dangerous phase of a cycle is not fear. It is comfort when risk feels distant and exits feel unnecessary. By the time fear dominates headlines, prices have already adjusted. But when optimism is loud and repositioning is silent, history suggests something else is happening beneath the surface. Smart money rarely rings a bell. It simply walks toward the door slowly, methodically, and without announcement. The only question is whether we are paying attention to the footsteps.